I think we're good to go now.
Cheers.
So it's been a while since I went downstairs and got a sandwich because it seems like there's not enough hours in the day. So ordinarily I eat lunch at my desk, as you do as well. But welcome everybody to the April 26th edition of the Jack and Bill Show, 2024.
Yep.
So we've had a lot of back and forth activity. You know, we came right out of the gate, and S&P 500 ran up to I think like 10.5% returns year to date. The bond market had been on a tear, and then it abruptly did a reversal. And I'm looking like through year to date through today, the Dodge and Cox Income Fund is down 3.0%, and Jeffrey Gundlach's Double Line Total Return Bond Fund, it's a huge fund, it's down 2.7% year to date. And I would say that the ag is approximately right in there as well. So we've had what have we had happen? We've had a lot of stuff happen. We had the October of last year with the October 7th, I think, when Hamas attacked Israel. So we've got that thing going on right now. We've got
Still have Ukraine.
It seems that each day there's the potential for escalation. And then we had
Taiwan.
We had inflation coming down at a really good clip pretty quickly from, I think 9.6% was the highest number we saw year over year on the CPI, Consumer Price Index. And we got down to around, 3-ish. I think that the core number is with the latest print, we're like 3.8% year over year. The Fed target is 2%. Yesterday, Bill, as you know, we had GDP. The GDP number was a big miss. So that's our gross domestic product. In Q4, in spite of the higher interest rates and all the Fed tightening, Q4 of last year, we had 3.4% GDP growth, and it fell in Q1 to 1.7. Of course, that's going to be revised each month in a row the next several months. But yesterday, the PCE price deflator that was reported alongside the GDP number was forecast to be 3.4, and it came in very hot at 3.7. Now, there are a few, I think you could call these people outliers, but there are a few people starting to talk that the next move by the Fed could be another hike. And so we had, in like September, with the dot plot given in September of 23, we were slated to have something like 4, Fed cuts.
More than that.
4, I think 5 maybe. Like 125 to 150 basis points, or 1.5 full percentage points, and that was predicted to have a lot of that already having occurred, which we haven't gotten any of them. And Jerome Powell is trying to calm the markets, and they're still forecasting, I think, 2 cuts for this year, but the numbers. But he's also said that inflation is going to have to continue down before the Fed is going to do that. And
Can I borrow one of your phrases?
Yes, sir.
Let's cut it with a meat axe.
Cut it with a meat axe.
Cut it with a meat axe.
I don't know where I got that. I don't think I have a meat axe. But
anyway.
I have a meat cleaver.
We'll leave it at that.
We could change it to cut it with a meat cleaver.
Okay. So, as you pointed out rightly, we had inflation peak, and then the trend was down, which was positive. We needed to see inflation get reined in. And there's a lot of reasons that we can point to in hindsight for the sharp rise in inflation. The Fed did what the Fed does. They pulled the biggest tool out of the toolbox to try to combat inflation, which is hiking the Fed funds rate. That's the short-term lending reference rate that has a big monetary policy effect. Historically, it has. And they have to do that because that is the primary mandate of our central bank, the Federal Reserve, and that is keeping price control, or inflation under control, price stability, I should say. So that's what they did, and inflation was trending down, and then whoopsie.
Maximum employment is the other part of the dual mandate.
Correct.
Yeah.
So yes, it towards the end of last year, the economic consensus was that we would have a number of rate cuts in the Fed funds in recognition that inflation was trending lower. And we haven't had a single rate cut this year. Some are saying that we won't have any. And yes, there are some people who take the view that we may even have a hike. Why is this important? Well, it's important because it speaks to the strength of the economy. It also can forecast the direction of investment securities. So Jack, if you want to take this one on, what would happen and what would we expectedly happen to stocks and bonds if we don't see interest rates come down in response to declining inflation? Over the short run.
Well, first off, you said in response to declining inflation. I think, are you making an implication that inflation is going to continue to decline? Or
well, I'm saying that there is a correlation between Fed funds rates and inflation. And so with inflation remaining higher for longer, we have not seen cuts to the Fed funds rate.
Yeah, I mean, I would say valuations of the U.S. stock market are rich. Mm-hmm. I mean, not fantastically, a little rich by historical standards, but any asset is worth its expected future cash flows discounted back to the present at the average weighted cost of capital. So,
right.
So if we're saying that if you look at the S&P 500 as an asset or a collection of assets, and you're discounting that back to the future at the discount rate is in the denominator, and that number is going higher.
Correct.
So that means that the valuation has to go lower.
Right. So we're discounting future. We're getting kind of wonky here, but
yeah.
When one way of valuing an investment security is using a discounted cash flow analysis. We don't need to get into all the details, but it's important that you, our audience, understand the role of interest rates in valuing investment securities, because this is what analysts are doing. So they're valuing or discounting these future expected cash flows generated by a security based on a discount rate, and that discount rate should reflect a company's cost of capital. So if interest rates are going up, well, their borrowing costs are going up. So their cost of capital is going up. And so when you use a larger discount rate to run those calculations, it reduces the present value. So valuations of investment securities come down.
And that's why you'll see that with the financials, the engines of our economy, the credit sensitive sectors of the stock market, not performing in line with the broader market this year. Think utilities. Utilities are large users of capital. Their cost of debt is escalating higher. Utilities haven't done well, in the last 2 years. So I think, and then we're seeing, we can shift gears a little bit with this. We've seen commodity prices. So with this realization that inflation has gotten a little sticky, we've seen the stock market go from up roughly 10.5 to up only about 5, and then it's rebounded here in the last week or so. Today we're up, the S&P's up about 1%. So that we may go home this Friday with the US stock market up about 7.5%, which actually, I mean, to just
Still
put
good.
that into perspective, that's fantastic. It's not where we were, at the end of March, but that's a fantastic start. But, the question is, where are we going from here? And we've got, commodity prices, I think, are up something like 7 or 8% this year after kind of pulling back last year. We had seen commodity prices run up in 2022. And yes, the Dow Jones Commodity Index is up 7.65% this year, with crude oil up 16.7%, gold up 13%, and just a large basket of commodities that comprise that index are up.
And there is a connection between commodity prices, especially gold, silver, and oil, with inflation. Now, we know at the end of the day that commodity prices are affected in great part by supply and demand. So when we talk about these geopolitical issues, geopolitical risks around the world, especially in the Middle East, that can impact supplies of crude oil. Geopolitical risk can also result in greater demand for gold. So supply and demand have a big effect on these commodity prices. But we also see, from a portfolio management standpoint, investors buying these commodities as a hedge or protection against rising inflation.
So think gold.
Exactly.
Think gold and silver.
Exactly. So we're seeing commodity prices going up, and the inflation numbers, and there's different measures of inflation. Jet mentioned CPI, PCE, a deflator. There's a whole host of inflation measures that economists look at, but they're staying higher. And so there is a concern that inflation is lingering. It's not under control yet. But the conundrum that we're seeing right now, and we pointed this out in a post this week, is that even though gold and oil, which are priced in US dollars globally, even though they're going up, the US dollar is going up too. And that's unusual, because normally, historically, when we see gold and oil going up, we see the US dollar declining. So something has to give here. This is a temporary phenomenon.
Well, I saw this likened to the late 70s to 1981, where gold very quickly went from $250 an ounce to $800. And, we've seen $2,400 recently. To put that in perspective, silver trades at roughly 55-60% of where it traded in 1980. So it's got a long ways to go, but there could be more to this story. I mean, I think
there will be.
We've had a strong dollar, as you pointed out in your post, because of higher interest rates.
That's correct.
But this, historically, those are meant to be real rates. And I think so that can be problematic for the dollar, because our real interest rates are not that high. They are by historical standards on a short-term basis. But there's some people, like this Bank of America's market strategist, Hartnett is his last name. He's saying that the explosion in gold, in some ways, he feels is showing that investors are preparing for some kind of an end game.
Trouble.
And I'm reading our friend Scott Carmack, who runs the 5-Star Mutual Fund, the Holbrook Income Fund, wrote in his weekly commentary this week, this fund has had a spectacular week this week. And he runs a short-term bond fund because he believes that we're in a secular, that means secular, long-term bond bear market. And he says since the bear market began in 2020, there have been 4 separate occasions whereby the 10-year Treasury yield has fallen by at least 90 basis points, or that's nearly a full percentage point. The middle of 22, end of 22, March of 23, and end of last year. In all of these prior episodes, the moves were fully reversed and yields continued to make new multi-decade highs. So he's also said that if somehow, if there's political pressure to ease interest rates, I've actually heard President Biden say that we're going to get some interest rate cuts this year. It's not supposed to be up to him. That's supposed to be up to the Federal Reserve and Chairman Powell and how they vote on that at the FOMC meetings. But this is another quote that Scott made. However, if they choose to start cutting rates with inflation still running well above 3, i.e. that's where we are now, we believe the long end of the curve could become unhinged. And I think some people are believing that, and hence this is why we're seeing gold and silver and commodities going up, and also cryptocurrencies. So so what else, William?
Well, in the post this week, we also pointed out this bifurcation between monetary policy and fiscal policy.
Yeah.
I mean, the monetary authority of the U.S. Central Bank is, in theory, an independent agency. But Congress should also take a note from what the Fed is doing. So the Fed has been trying their best with the tools that they have to rein in inflation. And they should. Inflation is very problematic, especially for the U.S. consumer. And we continue to see high employment, pretty strong GDP growth, although we had a little setback here with the last print, in spite of what the Fed is doing. And we know, in hindsight, that it's because of loose fiscal policy. That's the Congress. So Congress, since the pandemic days, has been throwing out money left and right to try to stimulate economic activity. Well, they sure did. To the point,
with interest rates held at near zero for far too long.
And the Fed was rightly criticized for holding short-term interest rates at zero for too long. They were too late in responding to inflation and raising that rate. But Congress is doing nothing to help alleviate this situation. And it just seems like Congress and the president, through executive action, is just throwing out the money. And there is no free money. If it's coming from the government, it's not free. It's being paid for by U.S. taxpayers. This is not a political statement, not at all. But we do need to face the reality that paying for all these goodies through deficit spending, having to borrow to cover that deficit, is not a sustainable path. And I do applaud people like Jamie Dimon, the CEO of JP Morgan Chase, who are using their leadership positions to take a stand and point this out. Now, it may be an inconvenient truth, and in an election year, depending upon who you're voting for, I'm sorry, again, this is not a political statement, but we as Americans, we do need to do more. We do need to be pressing our elected officials to do something about this.
Yeah, Bill, I read citing Bank of America's Hartnett again. He wrote a fascinating article. I was trying to find it. I can't recall whether it was this month or March, but By the end of this year, interest on our debt is going to be, it's going to reach 1.6 trillion annually. And that will overtake our annual outlays. The greatest outlay that we have is what is spent on Social Security each year. It's about 1.3 trillion. Well, the interest on our debt is going to be 1.6 trillion by year end.
It's already surpassed national defense spending.
Yeah,
For the first time, we're spending more on interest on our national debt than we are on national defense.
Which is about 800 billion or 0.8 trillion. By the end of the year, the interest on our debt will be twice what we spend on defense. So this is alarming. Our debt. People have looked at Japan in this country and think that it's okay and that we can just print our way out of this. But you know, as we've read this time, it's different. By Reinhardt and Rogoff. They wrote that studying country failures for over 8 centuries. And there could be a point where long-term interest rates could go dramatically high because the American people, this is true of the other world central banks, when the population is afraid of the claims paying ability of the U.S. Treasury, our government, the ones who issue this debt. And we've seen in countries like Argentina or Greece, I mean, they get to 30 or 40% debt to GDP and the bond market comes unhinged.
No, we're not saying that we're like Argentina or Greece, not at all. We have something that is working in our favor, thankfully, and that is the U.S. dollar is the most important reserve currency in the world. You know, global trade is largely done in U.S. dollars, but there are other currencies that are encroaching on the reserve status of the U.S. dollar. It's not a given that it will continue. You know, it wasn't but what, a couple hundred years ago that the United Kingdom, you know, had that position. They lost that. Their currency lost reserve status for global trade. When we look at why people globally look to the US dollar as a reserve currency, you could say that there's 3 prongs to the stool. 1 is our economy, and 2 is our national defense. 3 is our rule of law. All of those things are foundational to supporting the US dollar as a reserve currency globally. And unfortunately, we're seeing all 3 of those undermined.
Yeah.
Now, I mean, I hate to sound alarmist, but, you know.
Very good point.
I mean, we do need to be realistic about this.
Well, I think the thing we can shift, you know, make a shift there and just say, what is one to do with their investment monies, given the possibility of these things?
We don't mean to sound doom and gloom, not at all.
No, and you know, I cited the Barclays aggregate index is down something like 3% year to date. Our clients have done way better because we own mostly short-term bonds. We own BDCs that make adjustable rate loans to mid-market America. We own 2 funds in that space that you can only get through the RIA channel, like Charles Schwab. Those funds are yielding the conservative one almost 10, and another one yielding almost 11. And neither of these funds have ever had a negative year. So there's also a tailwind in, if you think that interest rates could come unhinged and the long-term bond market could do horrific the rest of this year, there's ways to play that through commodity trading advisory firms, or you know, another term for that is managed futures. We've got a way to participate in that through exchange traded funds and an open-end mutual fund that we have a few of those that we really love that have done well and are in the sweet spot with that this year. That, you know, they will ride some of these really pronounced trends. They're entirely rules-based. These funds have a tailwind right now because they have a lot of cash collateral after they put these trades on, and they're putting it in short-term treasuries paying, you know, 5.3% or something like that. We've also seen when this market took a big dip, we did see a rotation. Value stocks perform much better than growth stocks. Now we've just had, I think it's important to have some growth exposure because I think there's going to be, you know, everyone has heard many times cliches about AI. So I think that semiconductors, nanochips, microchips, these companies that make these things should do really well for the next 10 or 15 years. So I think you know, you have to have some exposure, you know, to that. But the main point is being, so we own things that are real, that go up with inflation. Think energy, precious metals. Those things have really helped us this year. Adjustable rate bonds or short-term credits, low valuation stocks. Know what you own, why you own it, right, Bill? And be diversified.
Exactly.
And what would you add to that?
I would say this. I mean, be nimble.
Yeah.
You know, we've had this conversation with a number of clients recently about the benefits of being tactical in a fast-changing world. You don't want to overtrade an investment portfolio, and if you're don't know what you're doing, you probably ought to just, and you have a long time horizon, you probably just should leave it alone. But here's a good analogy. If you're driving down the interstate and it has a posted speed limit, say it's 70 miles an hour, and you have the pedal to the metal, driving the speed limit. Well, if you see an obstacle in the road, do you keep your foot on the gas? Well, no. You take your foot off the gas, you slow down. You may even have to stop. And I think that's an appropriate analogy for investing. If we see things that are problematic, we can take our foot off the gas, we can adjust the portfolio in a tactical way, and we don't have to be out of the markets. We just shift into different things. So that's one of the ways in which we're helping clients is we are paying attention to the world around us. We are paying attention to market valuations. I mean, why should we continue throwing money at investments that are overpriced, overvalued? Let's look at those things which are undervalued. Let's look at those things that can perform better in a high inflationary environment. And it appears that we're in that.
You know, you made me think of something, Bill, because I've had people ask me this. I can recall you used the term long time or long-term horizons. Imagine we're a Japanese person, 40 or 50 years old, at the time of, let's say, 1989. Tokyo, the journalists were writing that Japan was about to take over the world with technology, you know, the computing age, real estate, Tokyo every single day. And the Nikkei Dow, it's called the Nikkei 225, their Dow Jones, if you will. It hit 39,000 in 1989. Guess where it is today? It's 37,000 and change. Now, it did make a new high. It made an intraday high on the 4th of March this year. It crossed 40,000, but it's It's 37,000 and change. So in other words, that was, let's see, 89. That's 35 years ago. So 35 years ago, if you own the Nikkei Dow, all you got was the dividends of it. And that goes to show. I'll be 63 years old this Sunday, and I'm not ever going to have 100% of my assets in the stock market. You know, if I succumb to a 50% downturn, something we've seen several times since the tech bubble burst in 2000, you know, I wouldn't have time to potentially not have time to recover from that. So it's important to be diverse and
well, and I think people have also become accustomed to, well, there's only two ways to invest, stocks or bonds. So I'll just use a old 60-40 mix, 60% stocks, 40% bonds that's done well historically, and it has. But we also understand the importance of having multiple engines of return. This is something that we've talked about ad nauseum, it seems. We've given seminars on this. There are things that we can invest in to make an investment portfolio more efficient, give true diversification. I think it's more important than ever to have these alternative investments in the mix.
So talking about the most important thing though, Bill, we had the first round of the NFL draft last night. So I did watch some of it while I was eating dinner, and I noticed, let's see what our friend Dan behind the camera can add to this. Most unusual about last night's draft were several superlatives. There were 6 quarterbacks taken for the first time ever in the first round of the draft, and the 6 quarterbacks were taken by the 12th pick. What's his name? Bo Nix. What's his name, Dan?
Bo Nix is his name. He played a lot.
Bo Nix. This is another interesting thing about this era. Guess how many starts he had in college? 61. Okay, if you play 12 or 13 games a year, how do you have 61 starts? You get on that COVID bandwagon and you get extra years of eligibility.
Right.
There's a tight end coming back to Miami who's going to attempt to play his 9th season. I mean, this stuff just doesn't seem fair. But anyway, going back to the draft.
Well, maybe he's trying to get his student loans forgiven.
The first 3 picks were quarterbacks. LSU's Jaden Daniels going to the Washington Commanders. That's a little bit of a controversial pick for them, how they're going to utilize him. But, that was Caleb Williams going first to the Chicago Bears. Everyone already knew that. And then Dan, our Tar Heel in the office, rightly predicting his quarterback. What's his name?
Drake May.
Drake May. I've read a lot of super things about him. He was picked number 3, but the first 14 picks of the draft, Bill, were all offensive players. That's something that's never happened before either. And I'm just thinking, man, are they just going to only play offense this year? Mm-hmm. And it's going to be very fascinating to me to see who's going to be the rookie of the year. That'd be a good bet right now. Rookie of the year in the NFL for next year. I'm sure you can make a wager on that, right now. But LSU had 3 picks in the first round. Washington had 3 picks in the first round, including their quarterback, Penix. He went 10th, I think. They had a wide receiver picked really early. Alabama had their 3 picks. I think if you were doing the over-under on Alabama, if you won if you had the under. Usually they have way more than 3 in the first round or first 2 rounds. But thought that was a fascinating and interesting draft. And
all right, you know what I thought of when you were describing that, and the emphasis on offensive players in the draft. So the emphasis on offensive production. What wins games?
Defense.
Defense. So maybe take that and translate that over to your investment portfolio. Have some defense in your investments.
There you go. Yeah, I mean, I think, hey, this is what I was talking to my friend Steve Umberger this morning before he was catching a flight out of Lafayette. And I was asking him what he thought about Bo Nix having 61 starts and going to, who's the coach of the Broncos now, Dan?
It's the old Saints coach, Sean Payton.
Sean Payton. What does Sean Payton see that, I mean, is this guy going to be the next Drew Brees? I mean, this is what Steve said. Steve owned 2 arena football franchises. He said, usually if you're really, really good, you go to the NFL your 3rd season, you know, and he played 5 or 6 seasons. Was it 5 or 6?
However, 61 divided by 12.
Yeah. So yeah, exactly. I think he played 5. He started every game in 5 seasons.
Right, so maybe he was a late bloomer.
So that's going to be interesting, really interesting to see, because they've had a big shakeup with the quarterbacks there, and he is supposed to be a genius with this. So
I mean, Jaden, late bloomer.
And we'll see how he goes, because he probably doesn't have one of the stronger NFL type arms, but he's definitely a scrambler. But I'm going to tell you right now, man, his first game, when he gets knocked around a little bit, it's not going to be like playing in the SEC. It's like another level when you could run past people. You know, if you're playing Mississippi State, you're not going to be running past, you know, someone on the Philadelphia Eagles. So anyway, well,
that bell ringing is in your head. Yeah. It's not a fan with a cowbell.
Yeah, really. I can just picture someone picking him up while he's got stars in his head and saying, "Welcome to the NFL." So if you don't scramble better than that, NFL stands for not for long.
Right.
So I think, well, we're kind of rambling here. Thank you for joining us today. Hope you have a fantastic weekend. Stay safe, and we'll be back to you soon.